Hit it.
It's Friday, January 31st, 2025, episode 257. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome Ole Hansen, commodity strategist at Saxo Bank. We have a wide-ranging discussion about commodities, drilling down on where he sees the opportunities and what he loves best. Then Patrick tries to figure out what color crayons the Trump market likes best in talking charts.
I think it's red, buddy. Anyway, and folks, we might even drink some beers along the way. It's a little too early for a couple of you lightweights, but here in Mexico, I got myself a Modelo. We're not going to even describe it. I think it's a pretty standard beer, but it's what I'm cracking open today.
That's a standard Mexican beer. I don't even know.
Yeah, but Danny, you like it, don't you?
I do. I like Modelo. You got to put the lime with it. If you don't put the lime with it, then it's awful.
I have it in a can. I'm not. No.
All right,
so it's immediately disqualified by you.
Yeah. You're putting fruit in this beer.
Kev, go for this.
Nothing in this investment podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the earnings erosion edge, the bond market blowback, or the Fed flip-flop fracas. Ooh, I think you're just picking these, Patrick, to make it so I'm going to step over them and not going to be able to pronounce them properly.
Yeah, the tongue twisters on purpose, buddy. Yep. All right, let's get the guest on.
It's our great pleasure to welcome to the show Ole Hansen, the head of commodity strategy at Saxo Bank in Copenhagen. Thanks for coming on so early in the morning. Well, actually, not early for you, early for me.
Exactly, Kevin. Good morning to you. It's early afternoon here in Copenhagen.
That's nice. Great to have you on. And listen, we were chatting a little bit before the show. You were telling me a little bit about your background, and it's fascinating. And let's kind of jump into it because so many of the things that you said, and you started talking about your first commodity trade and stuff, that rang so true to me, and it felt like you were speaking my language. So first of all, why don't you tell people where you grew up? Like, did you grow up studying and always wanting to be in the markets, or was this something that came to you in university? Like, how did that evolve?
Well, it evolved most certainly from the outset that it didn't evolve at all, because with the exception that my first years, the first years of my life was probably focusing mostly on agricultural commodities, because simply I grew up on a farm.
Oh, okay.
In the central parts of Denmark, so it was mostly just looking after the animals and attending the fields. I took my exams. I then went to Copenhagen, started working for a major bank, and within a couple of years, I basically ended up in foreign exchange. And that was back in, now I'm just revealing my age, that was back in '86. And back then it was really the old clunky telex machines and telephones. If it had more than 2 or 5 lines, it was a massive invention. So it was an interesting time to start in the market.
Well, it's an interesting time to start in the market. It was actually a very exciting time in foreign exchange. One of my things is that I've been talking about recently is the fact that I think that we're going to have a return to those times. What was it like trading foreign exchange back then? And who were you trading with retail clients, or was it institutional? What were you like? Fill us in a little bit more about those first years on the job and what it was like.
Well, the first years, obviously, I was mostly what you can characterize as a bit of a runner. So I was just servicing the traders, not only with coffee, but obviously also managing the telex machines, where things was obviously evolving at a much slower pace than what we're seeing today. So the telex machine lit up, and so there was a request coming in from a bank anywhere in the world asking for a price, and it could be dollar mark, and you shout across to the desk asking for a price and so on, so much, and then you trade it sometimes. And the time from the request came in to the deal was done could easily be 10-15 seconds, and obviously today we're talking about milliseconds or thousands of a second for a trade to be executed. So it was a much slower pace, but at the same time there was obviously a lot more, you can say, energy in the market, because this was done over the phone. It was voice, it was boxes that were just shouting the quotes from brokers coming in from all over the place. So we were covering not only our own account, but also institutional clients in Denmark back then. And Denmark was, and Scandinavia was a very active environment for foreign exchange traded. The interest rate arbitrage was really started to in earnest, I would say, in from some of my colleagues at the bank back then, when they started to see these big interest rate differentials we saw in Europe, and how that could benefit you from an FX perspective. That really kicked off back in the mid to late 80s, and became what it is today.
Well, okay, first of all, you are showing your age when you're talking about asking for price on D-marks. And then the fact that the telex machine, and people probably like, what does that even mean? But this idea that the carry trade was not invented, but popularized in there, that's fascinating. Why don't you kind of walk us through how that evolved? What did they see? Maybe give us some examples of the best you can remember. And was this something that ended up being a big profit center for you guys? Like, was it the main trade, or was this just kind of one more tool in your arsenal when you were trying to figure out how to set prices on FX?
Well, apart from companies obviously operating and servicing their needs in terms of currencies from their exports and their imports, it was the emergence of interest rate arbitrage, simply because we had within the European, it's not called Union back then, but we had the European community. We had a whole host of currencies. Today we only have the euros, but we had the French franc, the scooters in Portugal, the pesetas in Spain, the lira, and so on. And individual countries had individual levels of interest rates, and obviously over time, the volatility between the individual currencies started to come down, basically meaning that you could utilize the interest rate differentials by being long by being long the high yielders or the high interest rate currencies, and funding you in the low interest, which was typically the Deutschmark. And as we started to moving towards the European Union, towards the EU, then obviously these or the euro, these currencies slowly converged towards the same level in terms of interest rates, and that basically meant that there were some years that where some great profits in the market. There was also a massive upset, and that was actually caused by my own country, Denmark, when we voted no to what they called the Maastricht agreement, where everyone took for granted that this was just going to move in one direction towards all currencies or towards all interest rates being at the same level. But the Maastricht rejection basically threw everything open, and we went through a period of very high volatility. Then we obviously had the Bank of England or the sterling crisis, but yeah, it was a lot. But there was a lot more volatility back then compared to what we've seen in recent years. I would say up until recently, because the currency market is coming back, and obviously what feeds the currency market is the interest rate differential. It is the interest rate arbitrage, and now with the fact that we come out of a period where interest rates were close to nothing, and we're starting to see differentials start to emerge again, then that means the currency market is starting to become more interesting again from that perspective.
All right, so you're doing FX, and eventually you go and you start trading more commodities. Walk us through how that kind of change in your career occurred.
Well, I must again admit, it was not a big grand plan that I've set out to achieve. It kind of came by a bit of a coincidence, because I was in my first years I was sent to Luxembourg for 6 months working there, and literally just before I was heading back to Copenhagen, I received a call that my colleague in Copenhagen, who traded futures, so we only had one guy. This was one of the biggest bank in Denmark. We had one guy trading futures, and he had just resigned. Okay. And there's only one other guy who actually knew about futures trading, and that was my boss in Luxembourg. So my stay was extended for a month, and I just basically learned whatever I could from him. And then basically since then, I would say the futures market has been kind of the red thread through my career in all the different jobs I've had in the past few decades.
So when you say futures, you meaning that you were taking orders, trading proprietary? Like explain to me what your new role was.
In the beginning, it was primarily proprietary. And it was fixed income mostly, because we had we had a lot of trading in the bond market. The Danish mortgage market was already back then very popular. Interest rates were a little bit higher than the government rates, and security was almost as high as government bonds. So there's a lot of interest. So it was just a hedging tool that we we started using futures for that, and then later on it became more. It evolved more. But during my stay when I worked for the bank, which I did for almost 8 years, it was primarily in a hedging capacity until I moved to London. Then it became more of it brought out the spectrum of what we traded.
Before we get on to that, I just want to know, in terms of the Danish market, you mentioned mortgages. What does it look like? Is there the prepayment risk like there is in the US? Like, do you end up being short the call, or is it more just straight like 5-year, 10-year that you end up rolling? Like, what does the Danish mortgage market look like?
Well, it's typically or at least up until a decade ago, the typical mortgage was a 30-year mortgage.
Oh, it was. But you have the same as the US.
Yeah.
I didn't know that.
But then obviously you had the ability to redeem, because how they do it is that just the mortgage banks they pool all the different loans that they have to make to individual buyers of properties. They pool that into one big issue. But that also means that if you over time you sell your house, you need to repay your mortgage. Then so obviously there was redemptions along the way, making the duration much shorter than what you normally would have on a 30-year mortgage. So
is that typical in Europe? Because I thought that was kind of a uniquely American thing, and I'm actually surprised to hear that you have, in essence, the same system.
I think it is quite common, but there are different systems from country to country. But at least in Scandinavia, I think that's a normal standard that we have. Quite often, the loans tends to be shorter than the 30-year that was the benchmark in prior times, but in recent years. But now we're seeing a lot more focusing also. Just I think probably 10, 15 years ago, you were allowed to fix your mortgage on very, very short duration, all the way down to a year.
Okay.
And because we generally we have a steep yield curve. Well, it has been fairly flat, but generally short-term rates has been lower than longer-term rates. So that obviously did attract a lot of borrowing in the short end, because you could basically ride the curve, and that was very beneficial for up until 3 years ago, when suddenly interest rates spiked and a lot of people were left out of pocket. But yeah, it's you have the ability to do anything from 1 year to 30 year, and it really depends on your credit worthiness and how much you're allowed to borrow.
Right, because here in Canada, we have trouble getting past 5 years. Like some offer 10, but the reality is that 5 is kind of the standard, and we don't do that. All right, so let's go to the next stage of your career. Walk us through what happens to you next.
Well, as probably mentioned, part of my career then took me to my first bank took me to London, where I worked for where I ended up basically staying for 20 years, and it took me from the banking side to the buy side to the sell side. In the early mid 90s, I became a futures broker. I worked on the London Futures Exchange, and again now we moved along from the telex machines to open outcry, and even for younger listeners, open outcry, they will think, what the heck is that? and that's really where that was the very, very interesting years, I would say, because being involved with futures trading when it's open outcry, that just seeing the whole dynamics of how that is, how markets are executed, and how a big pit full of maybe 100 people, how they can make this thing actually works. It still beggars belief that there weren't any bigger number of errors than the ones we had. But crazy thing was, I was sitting in the office taking orders, and especially when we had big numbers coming from the US, sometimes you did not know your fill for at least an hour.
Oh gosh!
And because when you had these big market moving events, it became fast market, as I said. Basically, meaning that the normal order in the pit was temporarily suspended, because it was just simply impossible to see where price were trading. So sometimes price were actually the same product could be trading at 2 different prices depending on where in the pit that the order was going in.
Right.
So sometimes it could take more than an hour before you actually got the fill out, and it was quite stressful because obviously clients wanted their fill. At the same time, new orders continued to come in. So
is that the life? Is that this London International Futures Exchange? And
no,
so that's primarily financial futures. Am I correct?
It was indeed, yeah. It was indeed. So our biggest markets again from for the clients we covered back in Scandinavia was the fixed income market. So it's the German Bund, again using as an offset against the local bond markets.
Okay.
Also the short-term interest rates, which were very actively traded back then, which now is coming back again, following a number of years where not really much activity was taking place because interest rates were as low as they were and as with the volatility being as low as it was. But yeah, it was primarily fixed income. And again, it was just phenomenal, amazing seeing these traders because some of them just had very, very good merchant skills, very good at understanding markets, buying and selling. And then you went to the option pit and you had these guys standing there with their calculators and just working out all these option prices. And I was just always astounded how they could keep all these prices together at the same time.
Is that the life that become the Eurex? Like, is that where are all those contracts? Or is it like, did they get amalgamated into one?
Yeah, it was over time. It was the ICE Europe.
Oh, maybe the ICE. Yeah.
And I was there when the Eurex exchange in Germany basically launched the electronic version of the Bund future, covering the German government bond future. And at the start, we didn't really see that as a threat, but obviously over time, in a relatively short space of time, you could see how quickly that the volume started to shift to Frankfurt from London. And that was I took that as a sign that maybe it was time to move on because this was actually going pretty fast. I think the biggest story was from Paris, where the French Matif government bond futures contract was trading. They had plans that they were going electronic because they could see they couldn't avoid it. And they were planning to have these two markets running side by side. But basically, they launched the futures electronic contract in the morning, and by the afternoon, the floor traders were playing football in the pit.
Seriously, it was that fast.
That fast. So it really the life to a certain extent, the life exchange to a certain extent lost some market share because the Bund was by far the biggest contract, and they went to Frankfurt. But I remember back then, if we had a very, very, very busy day, the contract from the whole perspective would probably trade. If we did 100,000 contracts across the exchange in the Bund with all the total volume 100,000, it would be one of those days where all of the floor traders they lost their voice. They probably need a few beers just to recover, and then home to hit the bed. But these days, 100,000 can almost be traded in a matter of seconds. So it just obviously highlights that there was a limitation for how much the open outcry could cope right. with in terms of order size and turnover.
Okay, so you see the writing on the wall for electronic trading. What's the next stage?
I got the opportunity through connections to join a hedge fund, an upstart, a CTA, which had only back then been in, I think it's been in business for a little bit more than a year. The manager was showing really good potentials, and they needed someone to help out on the futures desk, which was basically expanding at the time, and we were really quite heavily involved in the commodity space. So that's really where the commodities started to come in. But we went from around $100 million within a few years. We had some like $1.5 billion under management, and if you can imagine that sometimes the exposure to commodities were close to half of that, then you start to become extremely active and trade a lot. So basically everyone in the futures market back then knew who you were because of the kind of the sheer scale of activity that we were providing, but also trading a lot of forex through the futures market, which we then EFP'd into the cash market. But it was 8 years. It was eight fantastic years where I learned a lot, and where also the fund managed to deliver very solid returns.
Were you guys trading technicals? Like, were you trend following, or was it a fundamental base, or was it a combination of both? What was the strategy based on?
Well, the strategy was very unusual because what the manager, when he started in trading, he had a mathematical background. He's probably one of the best trader I've ever come across. And he later on that was, but he started off with money, and he lost a lot. He lost, I think, 30% in his first year for the company he then worked for, and he thought that's not good fun. So he basically did not trade for 6 months, started to analyze charts, and we were only looking at the naked chart, no trend line, no moving average, no nothing, and started and worked out some patterns, which we then started applying our trading activity to. So basically, whenever we looked at the chart, we looked at just bar charts, nothing else. But we looked for how the different bars and how the patterns started to emerge, and that really gave us an edge. But then on top of that, one thing is having the right signal. The next thing is obviously what kind of position size should you apply to that, and that's really where his canny understanding for the markets and how for the understanding potentially how strong a trend was going to evolve into meant that we had some really good runs, and that but from that perspective we're not that different compared to hedge funds today, because I watch the COT report weekly very closely, especially what the managed money money does, simply because they're not married to their positions. They will respond to price changes, but at the same time they're also trying to look for these big trends following the momentum, which obviously means that quite often hedge fund money are being by some characterized as dumb money, which is obviously the last thing they are. But they're only dumb in the sense that when they manage to catch these big trends, they will also be the ones that hold the biggest long at the turn of at the peak, or the biggest short at the through in the market. But what we tend to forget is that before we got to that peak or to that through, they were basically sitting on the right position all along, and that basically means that they benefited greatly from these movements. So, and again, remember what happened in 1999 to 2000. Basically, China emerged as a massive force in the commodity space. So we basically had a decade where commodities was almost in a one way direction.
Right.
We saw a massive jump in if you look at some of the major commodity indices during that decade, and we were riding that. Part of the strong performance was that the fact that we were riding that these big bull trend that we saw back then.
One of the things you mentioned there is that this boss, or the fellow that you worked for, was one of the best traders you've ever seen, if not the best trader. What was it about him that he was able to do that you think was so good and that other people struggle with?
Not blinking an eye, but trusting his strategy. Basically meaning that again, clearly when we were entering into new positions, that's always when you have quite a little bit of volatility. We also see that in the markets today, that when we make a new high, when we make a new low, if it fails, then there's always a small pullback because there will always be buyers into strengths and sellers into weakness, and the how you manage that period where it's really quite difficult until you hopefully get established a trend. That's really where you can lose a lot of money if you're not careful. And he was extremely good at that. And then on top of that, he just had a phenomenal photographic memory. He could remember markets, price action, peak highs and lows across 50 to 60 different markets going back months. So it was just phenomenal to watch. But I think his steady hand, and that took us through some of the major scares we had in the markets. I think probably the only time I remember we did something that was unusual was 9/11. Simply because
so unusual an event, right?
Yeah, it was a very scary day, and we were all and I get goosebumps now because we had direct lines to the tower that suddenly died.
Oh.
We had brokers sitting up there, which we lost on the day, and not our company, but the brokers that we were trading through. So it was emotionally a very, very tough day to get through, even though we were sitting so far away over in London that time. But simply the fact that the market was starting to dry out, freeze up, was one reason. and then again we were almost positioned across the board in the right direction, because ahead of 9/11 the market was starting to price in an economic slowdown. So short-term interest rates futures were they were pointing towards lower rates. Stock markets were looking wobbly, and so on. But generally, the fear of markets freezing up and closing down was obviously also one reason behind that move. But generally, otherwise, throughout many other big events, there was a steady hand, and that obviously benefited us greatly over time.
All right. And then I guess the next stage and the final one where you are now, is that correct? You moved to Saxo Bank, and
exactly.
What drove that, and tell us a little bit about your role there.
Well, 2008, family decision. Our daughter was 2 years old at the time, and we had to make a decision, where do we want to be the next 10 years? It's actually something as simple as the fact that we were visiting friends one summer. As I said, our daughter was probably a year and a bit at the time. We lived in London, loved it, but obviously a very busy place. At night, 9 o'clock at night, we had a barbecue with some friends. Their daughter, she was 12 years old. She says, "I'm just going to cycle over to see my friend." And I say, yeah, fine, we'll see you later. And my wife and I just looked at each other and said, she's what? On her own? And then, of course, we realized, of course she is, because she can. Security, safety, there's nothing, you don't even think about it. You just do it because that's what the lifestyle or the security allows you to. Right. And we thought kind of that kind of was a bit of an eye opener. So we made the decision to move back to Denmark. I had some contacts through in London that worked there, and I got the job at Saxo Bank, and which then within a couple of years turned into become purely focusing on commodities, and basically I've been focusing on commodities now for the last 15 years.
That's awesome. All right, so let's talk a little bit about those commodities and what you see in the market now. Let's start with maybe your general view. You mentioned the big bull market of China in terms of the late 90s, early 2000s. Are we ever going to see something like that again?
Probably not, simply because we're not going to see such a unified demand across all the sectors from one specific source to the extent that we have seen that we saw back then. Probably the opposite is the case now, where we some areas we've seen some saturation. If you look at China, obviously the property market is they've overbuilt, and that's so it's probably not steel and iron ore you should be focusing too much on in the short term, unless we move towards a situation where obviously steel is also into defense, and obviously defense budgets are going through the roof around the world right now, and so we're just seeing a change in demand structure. But generally, we went through I would say almost a decade after the great financial crisis, where China came in with a massive amount of stimulus, and that created a lot of overproduction, and that created a number of lean years where commodities didn't really do a lot. We had most markets in trading in contango, basically means from an investment perspective, it wasn't that beneficial. You were basically paying to be passively long because of the structure of the forward curve. Right. That started to change, and that started to change really dramatically after the pandemic in 2020, which would then led to the inflationary spike, but also a massive pickup in demand for commodities, which since then has changed the equation somewhat. So I think the world is moving in a direction which in certain areas is fairly unpleasant. It's not nice, and I'm not talking about the US alone with politically. That's not at all what I'm trying to say. Basically, we've gone from a couple of decades where it was all about globalization, and obviously now the brakes are being applied, and we are seeing deglobalization. We're seeing defense spending. We're seeing the electrification of the world gather momentum, basically meaning that we are not going to run out of oil, maybe not gas, but we potentially could at a point in time be struggling with not having enough power. And we just seen this past week with the big sell-off, with the DeepSeek related sell-off, also in power producing companies, but that's probably primarily due to the fact that some of these were has risen by more than 200% in less than a year. So there was a correction long overdue. But we are in a world where demand for power will continue to rise. Demand for green metals, lithium, copper, aluminium, and then my favorite is the investment metals, simply because as long as we have an uncertain world, as long as we have central banks looking to reduce their holdings of dollars, so long we have a debt situation which is not out of hand, but we have some fiscal debt worries, not only in the US but also elsewhere. These are all drivers that attracts renewed investment demand into precious metals, and we've seen a clear sign of that in the past couple of years, where gold and silver has managed to rally quite strongly despite the headwinds from rising real yields from a stronger dollar and so on. So generally, we're positive on commodities. What this first month of the year has also shown has been a decent rally across the agricultural commodities, and that is a little bit of a worry, because I suppose we can all live with cocoa prices doubling in a year and coffee prices doing the same, even though I'm a bit more concerned about coffee getting too expensive. But we have been, I almost say, blessed with relatively low prices for key food commodities like rice and wheat. They're still reasonably low, but there are also some signs across some of the others that we've seen some low points, and we may see higher prices in the coming months.
So lots to unpack there. I'm going to start with the investment metals, because I think a lot of people end up trading gold. One of the things that you highlighted is the fact that the relationship between real yields or yields and the US dollar and gold has broken down, and it's largely a function of the fact that the central banks, mainly led by the People's Bank of China, has been buying gold. One of the things that I can't remember who said it, but someone said central banks buy gold, they don't buy gold stocks. So we've seen the gold companies actually struggle a little bit. One of the other things that I was thinking about on that vein is the fact that they also don't buy silver, they don't buy palladium, and they don't buy platinum. So gold has been the best performing of these investment metals, as you mentioned. Do you see a situation where that's going to actually change? What would it take to change? What's your opinion in terms of those other investment metals relative to gold? Will gold continue to be the leader, or could we actually see a broadening of the investment metal rally?
I think we can easily see a broadening, and I think we have actually seen it already. Silver more or less managed to keep up with gold last year, but what we have to remember, both with silver and to a certain extent also platinum, is that they are basically gold on steroids. Basically meaning that every time whenever gold rallies, they tend to rally as well, but harder. But the same thing goes for in the opposite direction, and that means from a more low volatile investment, gold has obviously proven its worth quite a bit more than silver and platinum. But at the same time, the outlook for supply and demand when it comes to silver basically points to another year where we may have where we will likely have a deficit, and that basically means that above ground storage inventory levels are coming down, and that basically means that it's not central banks that's buying silver, but it's the industries that provides that build solar panels and so on. So the industrial usage, which is roughly 55% of the usage of silver, that goes in that direction, and a very growing part of that has been solar panels, and like it or not, I think that growth will continue. China's been leading from the front, but we're seeing a massive rollout in the Middle East as well, and elsewhere where the sun is available, then that's going to continue to apply some underlying support. So I think, yes, the ratio, if you look at the gold silver ratio, it's for the past couple of years, every time it gets close to 91, so 91 ounces of silver to 1 ounce of gold, we found fresh buying interest in silver. We just saw that this month as well. Okay. We broke above 91, and now we're back down to 88.5, and we were actually as low as 74 last year when silver broke into the 30s. So
if I'm not mistaken, silver is often a byproduct of the copper mining. Is that correct? Like in that the issue was that when you go and you start making some copper mines, you end up getting silver, so it's not its own supply demand. I take it as well, probably that China's slowdown of the past year or two has also kind of crimped the silver demand. But you're saying that when you look at that picture of the demand versus supply, we're actually in a deficit, and yet the markets continue. It doesn't really trade. It doesn't trade like that. Why is that?
Well, I think that's probably due to the fact that it's not yet strong enough really to have to be the main focus in the market. But I think we've seen in China, even though China's been going through a slowdown, they have changed their focus away from properties towards the renewables, and silver is part of that story, and copper is part of that story as well, and that's the reason why even though last year was a bad year for China, and which accounts for more than half of the global demand for some of these metals, but despite of this, the metals held up very well, especially copper, and it just highlights that there are other sources of demand that is starting to emerge than instead of just wiring of houses for the electrical side of things. And I think that is a trend that will continue to add underlying support to silver. So we're looking at, in our outlook that we sent out early in January, we were basing our based on a conservative call for gold to reach 2,900. We could see silver reach 38. So that would bring the ratio down to the mid 70s, where we traded around March time last year. So basically looking for silver to outperform, simply because of the underlying industrial demand remains strong. And then you mentioned platinum as well. And I think if gold continues this kind of momentum that we're seeing, then investors will also look for relative value. And on a relative value basis, I would say silver is cheap, platinum is dead cheap. It's probably never been. What is the ratio right now? I'm just looking on my screen. It's a 2.
What do you tell people a little bit like what's happened in terms of the catalytic converters and why platinum and palladium are so cheap? And you're absolutely correct. I do believe this might be a record low in terms of platinum versus gold.
Yeah. Platinum was for a number of years the go-to metal when it comes to converters, and I think you need to go back less than a decade, and platinum was trading at a premium to gold. Now it's trading at a several hundred, 18. I'm just trying to. I can't even work. $800-900 discount to gold, as far as I can see. No, even more than that. So it is a phenomenal outperformance that we've seen in gold. But platinum was the go-to metal, but then palladium started to take over, and now we've seen with the move away to the move towards something like the still gasoline engines, but also the hybrid cars. Then in that sense, it's platinum seems to be gaining an edge. And also remember, I think the palladium is almost source most of its demand from the automobile industry, where platinum it's got many other applications that where it goes to, meaning that it's less dependent on demand from the automobile industry. And I think that's probably why it started to outperform palladium in recent years. But it remains very cheap, and I think when you consider that production is primarily out of relatively volatile production areas, South Africa as being the main one, and with the above ground inventories not that high, I think actually the Platinum Investment Council, they are forecasting a deficit there as well.
Right.
That basically means that if we start to find or if we start to see a theme emerging where investors are looking at scarcity, they're looking at potentially inflationary risk, they're looking at commodities where the value is likely to be maintained due to a scarcity of supply, then platinum will fit into that story as well. So I'm struggling to see platinum getting much cheaper than where we are, but again, we haven't really seen a catalyst, excuse the pun, for a reversal or for a change in the outlook there just yet. But it's definitely one that I keep a close eye on.
Well, anytime a commodity goes below the cost of production or the marginal cost of production, you have to be aware and watch for it, because it ends up being that it's a cheap long, right? Because the reality is it can probably go lower, but it's difficult for it to get it significantly below the cost of production.
Indeed, and if I did may add as well, I think one mention at a time, because there's always this kind of talk about how much mined metals is there, how much do we know, and there's always a story about the gold lump, which I can't now remember how many meters square cube it is, but if you look at someone mentioned at one point, if you take all the platinum ever mined and put it into Olympic-sized swimming pool, it only fills it up by around less than a foot, so 20 centimeters. And so it is not a massive. It's a small metal. The availability is relatively scarce. So if we see demand through ETFs starting to pick up, then that could very quickly swing that market into a deficit.
Right. Got it. All right. You mentioned copper and you mentioned China. Why don't you tell us, first of all, what you think is happening in China? Is this, we had a lot of excitement in terms of, what was it, 4 months ago, when they came out and they announced their stimulus. And again, it was one of those things that market probably got way ahead of itself. And are we finally going to see a change in China? And is that needed to get the copper market, rip roaring?
I'm a little bit lukewarm on the prospect of China managing it really to turn around, because the initiatives they made so far is really primarily to prop up regional governments who are very, very heavily indebted, and whereas the big problem is really that the average Chinese person is not spending as much as they used to. The consumer spending is weak. They are obviously concerned about their future. They're concerned about their savings because the property market has stopped rising. The investment products that is available is relatively limited. But so there's a lot of savings going on, and that's really where you need to entice increased consumer activity, and especially if we are heading towards a trade war where tariffs will be applied, where China can no longer generate or grow through exports. They have to really rely much more on domestic consumption. So that is the big challenge that the Chinese government will face. But if you look at the underlying components, again, as I mentioned, copper last year, when we went through these commotions in China, actually held up very well. It does indicate that there are investments going on in China, and it has really very much been focusing towards the renewable side and towards infrastructure. And that basically means that the demand for copper has not really suffered that to the extent that one could have had feared. And that basically means that if we are looking outside China in the years to come, and with electrification and with the need for all that power to be transported, then it's difficult not to see a situation where mining companies may struggle to keep up with the demand that we'll see, because mining companies are also faced with some structural challenges, and the average time it takes now from a discovery is found till you actually start generating an income through getting the getting the metal out of the ground is more than 10 years, in some cases all the way up to 12 years. So I think we're sitting here trying to work out, or trying to come up with some clever thoughts about where copper will be in a year's time. But these guys, they have to look 10 years out in the future to make a decision for whether a big multi-billion-dollar investment is worth their while, and the process, I think, is potentially keeping production from growing to the extent that is needed. And also, all the low-hanging fruits in terms of mining has been picked, and making it just more expensive going forward to continue to get some like copper out of the ground.
So you think copper could surprise to the upside? Like, could you see a situation where, what sort of rally would you expect that you could see on that?
Well, we're trading around $9,100 a ton. If you look at the price in London, New York right now is quite a bit higher relatively, because we got the future squeeze due to worries about tariffs being applied to imports. But it's trading around 430, and with that in mind, over the next year, let's just conservatively say that we could see a 10% move higher, but because obviously we're yet really to work out the impact of Trump's policies and what kind of impact it will have on the global economy. And if we go through a trade war, which potentially could have a negative impact on the growth outlook, then some of these projections may have to maybe pushed a bit further out. But I think just keeping focus on the electrification of the world, and call it driven by climate change or whatever, there can be all sorts of reasons, but the electrification of the world is ongoing, and that will basically mean that the demand for power is going to continue to rise. Think about your electrical vehicles, but also think about your data centers. Think about the climate in certain places where you have to use more and more power just to keep cool during the summer. So there are some big trends that basically points to increase power consumption, and copper is an integral part of that.
You mentioned Trump's tariffs there. How are you incorporating those into your commodity outlooks?
Oh, it's very difficult. Simply because we don't. First of all, we don't know what level we're going to end up, but also we don't know what kind of the response is going to be to tariffs. Obviously, we're watching this weekend very closely with Mexico and Canada to see what's going to happen there, and I'm obviously from that perspective watching the oil market very closely because it's just. You sometimes get frustrated when politicians speak because yes, it's true. The U.S. is shipping out 4.5 million barrels from the Mexican Gulf on a weekly basis or on a daily basis.
Oh, one second. You misspoke.
Sorry,
there.
American Gulf. American Gulf. Sorry. Yes.
We don't want to get banned in the U.S. by talking about the Mexican Gulf.
The Gulf formerly called as named as no, that's true. So we got 4 million plus barrels being exported, but at the same time we got 4 million barrels plus being imported from Canada. And obviously that's a zero sum, but quality matters, and also the location matters as well. So if tariffs are being applied on Canadian imports, it's not as if they can just stop exporting from the south and utilize their own oil, simply because there's a big difference in the quality of these crudes, and the refineries cannot cope with all the domestically produced crude. Therefore, it has to be exported to other regions and other countries where the demand for, say, something like gasoline is higher, and that so it will be interesting to see how that plays up, and that ultimately could lead to higher gasoline prices in the US, because refineries will have to pay a higher price for the Canadian crude, which they still need. So all roads, I would say, lead to inflation, and obviously, if you ask the U.S. government, that's the opposite. It will bring inflation down. So we'll see what happens, but it's just very difficult, because one thing is the action, another thing is the counter reaction, and hopefully in a few months' time we will be a bit wiser.
Yeah. In terms of the Canadian crude, I'd be shocked if he doesn't exempt it. I think he understands that that's going to be just a disaster for their economy. And our Alberta premier has been flying down to Mar-a-Lago and whispering into his ears. I do expect that there will be an exemption for Canadian crude. Having said that, I don't know if the rest of our economy is going to be exempted from it. And I do agree that one of the things about these politicians, and they think that this is so great, all these tariffs, the reality is tariffs put up prices and then put down economic activity. And I think they're greatly underestimating the potential for a slowdown based upon these tariffs. Like, one of the things. Sorry, go ahead. Finish your thought.
Yeah, no, I just want to basically also just right now also just seeing the kind of upheaval where normal market functions are kind of being challenged, and we mentioned that a little bit earlier, that we are seeing that primarily right now with the metals trader and the futures market in New York, where the premium that the futures are trading at is obviously way above what normally should be when you take funding and storage into account, and that is obviously because of the the worry that if you are using the futures exchange in New York as a go-to venue for hedging physical activities, and suddenly the delivery that you need to take in, perhaps from abroad, to cover a short position, that you have to apply tariffs on top of that. And that suddenly makes your whole calculation go out the window. And that's why we are seeing this kind of stress right now, where prices in New York is trading much higher than where they should be. And we need to see some clarification. And I can understand why something like silver, where right now silver futures is trading more than $1 above spot silver, and not so much in gold, because gold is a financial and investment asset. So I would be extremely surprised if we're seeing tariffs on gold. But silver, coming to a large extent from Mexico, obviously could be one of the ones that are in the firing line. So we'll see what happens this coming weekend.
All right. One of the things that you mentioned earlier in the show was the advent of the grains getting a bid, and I'd love to hear your thoughts about what you see there. And is this the year that we get a surprise bull market in grains?
Well, the first signs shows that the risk is there, and we're actually seeing this. I was just writing my weekly my weekly update, which is now a monthly review, because we're at the end of January, and just seeing that the agricultural sector this month has been driven high by the 3 C's, and that's coffee, corn, and cattle. And cattle is obviously, the cattle future is very much US, North America centric, because the beef prices in Europe is not really reflected by the price we see in America, but US beef prices are trading at record high levels, and corn prices has reached the 15-month high, and it is not only due to worries about the weather developments in Argentina, but we recently saw the US government downgrade their production outlook for last year, and thereby also lowering the so-called carry-out, what's available in storage at the end of this current crop year, which runs to August. And that basically means that if you bring down if the inventory levels start to come down, then that makes you obviously much more exposed if we should run into a production season that doesn't end up being as good as we've seen in the past 2 to 3 years. So the risk is there, but inventory levels are still at a level where it's manageable. And then obviously we also have to see if tariffs are being applied on Chinese imports, will China respond by buying less agricultural commodities in the US? That could obviously add a little bit of downward pressure on some of these in the short term from lower exports. But generally, inventory levels are coming down, making these crops more exposed if we run into a year where the weather developments lead to a lower than expected production.
All right, that's great stuff. We're getting close to the end here in terms of time, so I'm going to leave you with a final question in terms of a commodity that we haven't talked about that you think that we should be talking about.
Oh gosh, well, actually, I love natural gas.
Okay.
Because I hate coal, and obviously, coming from a country of where on the good days, close to 100% of our electricity produced from windmills and solar. Obviously, I also know the risk to that. When you have days where the sun doesn't shine or the wind is calm, then we have to rely on other sources of energy, and that's really where gas comes in. So the base load requirements in the electrical system basically screams out for gas and uranium for nuclear power, at the expense, obviously, over time for coal, if we would like to bring down the level of pollution we're seeing in the world. So I think gas in the US is just dirt cheap, and I can only see the prices over time start to move higher. So the drill baby drill that Trump mentioned earlier this month, I think that's not going to ring true for crude oil, because there's not going to be the need for the additional barrels, because there's plenty of spare capacity in the world. But it may lead to higher gas production, which I think there will be demand for in the coming years. So I like gas.
That's great. All right. Before we let you go, why don't you tell people about your bank, what you guys do, and where people can reach out to you if they want to learn more about your products?
Well, as you mentioned, I mentioned I work for Saxo Bank. I've been doing that for 17 years. We are based in Copenhagen. We basically provide online access to global markets through our platform, and we have more than 1 million plus clients sitting around the world trading using the platform on a regular basis, getting access to markets. So my role there is obviously keep an eye on the commodities and trying to enlighten our customers with what's happening in the markets and where we see opportunities. And if you like to follow me, then you can follow me on X, Ole _ Hansen, and otherwise you can see my output as well on our website, which is analysis.saxo.
And you guys also have a podcast that you appear on fairly regularly, don't you?
Absolutely. Thank you very much for mentioning.
No
and my colleague actually mentioned, don't forget to mention our podcast. We have just recently revamped our offering there, because we used to have a daily podcast, which became very, very, very popular. We had quite a high daily listenership. We made some changes, which basically meant it became a bit more irregular. But we just recently, within the last months, really gone back a little bit back to our old format. So we do at least twice weekly podcasts, where we basically discuss markets, mostly from a technical trading perspective, not from a long-term investment perspective. But we try to look out for the traders out there, and who are actively involved in the market. So listen into that as well. You can again, you can find the links if you follow me on X. Otherwise, it's called the Saxo Market Call, which you can find on your podcast provider.
Well, thank you very much. It's a pleasure getting to know you, and thanks for sharing all your views.
Thank you, Kevin.
All right. All right, Patrick, it's time for talking charts. What do you got for us?
Okay, let's review what we were looking at a couple of weeks ago. But then, first of all, we were asking whether it's a breakout or fake out on crude oil. And at the time, several weeks ago, we were just at the beginning of this huge rip that ended up going right up towards $80 a barrel. So it was definitely a breakout. But now, in the last week, we've gotten this mean reversion correction, now testing some very important levels. So what's amazing is that we went from the initial breakout to now a reversion, asking this question again. Well, is this going to be a bull trend? I want to talk about that chart in a second, but will oil turn bullish here? Any thoughts on that?
I don't know, but I did notice that in your other podcast that you cheat on me with, you guys had a oil guest on. Are you guys back to talking about oil? Is that not the sign that the oil is going to go down?
That's Rory comes on as a normal rotation.
You don't want to say it, but you just say it's a good point.
I hope we didn't goocher it. Oh my God, we goochered it. Damn it. I gotta close my positioning. All right. Anyway, let's go number 2. We had obviously the big wave of monetary policy statements, ECB, Bank of Canada cut, and then obviously the hawkish FOMC. Well, any thoughts that you want to share?
I don't know. I kind of thought it was hawkish as well, the FOMC, but the market definitely did not take it that way. One of the things you might say is that he worked especially hard to say nothing. Like, I've never seen that guy. Like, I think, no, honestly, he's a lawyer by training, I believe. And like, he was doing like that same crap that lawyers do, which was like, never say anything, never give away anything. Like, that was literally what he did. It was just like, no, I'm not going to answer that question. No, I'm not going to do that.
It's funny, but you know what? If there was ever a meeting for him to do it, it was this one.
Well,
like this
one's
the
going
one
to be
where
any different?
There's so much uncertainty.
Yeah, but okay, I agree with you that he has to keep his options open. But he especially went hard to say, like, no, I am not going to comment, or I'm not even going to say, if he does this, we will do this. He refused to just go down those roads, period. Contrast that to Tiff Macklem at the Bank of Canada, who very clearly said, if we end up getting tariff 25%, then it'll mean lower rates because we're going to struggle. Our economy will struggle in that environment. And so we have
but it's a little That's a little different though, right?
Yeah, I get
because
it. Yeah.
the one is gonna take the knock-on effect, but the one thing that's not clear when you're the big player in the room is what your own government is about to do. Like the truth is that what like if you were Powell and you're saying, okay, well, look, maybe there's a chance that Trump is using this to simply as a bargaining chip for negotiating a better deal with Canada, and maybe if they get the right deal, they might not even tariff Canada at all.
Yeah.
And so the thing is that when you're in a situation like that with Powell, then Powell says, oh, well, let's see, like maybe 6 weeks from now, there'll be a far clearer thing of how the dust settled on all of this, and then we can make a more decisive stance.
Listen,
I just think that he needs his options.
I'm not disagreeing. I'm just saying that it was shocking how little he said. That's all.
Yeah.
It was
number
shocking.
one. Yeah, number one obviously was the inauguration itself, and I was really kind of wondering whether there would be kind of buy rumor sell news kind of dynamic into it, but really things just kept going. Like there was, to me, nothing dynamically changed on that. Maybe inflation numbers, the CPI was much more of a pivot than the inauguration was. Do you have a different stance on that?
Well, I don't know, but did it not have proved to be the top in the Trump and Melania coins? Shouldn't we be talking about that?
Fair enough. Fair enough.
What's your view on the fart coin Trump spread? Do you have a view?
You know what? I apologize. I didn't even look at it.
No.
I really wish I had something smart to say about it, buddy.
You really wish you had something smart to say about fart coin?
I
wish you had something smart to say about anything, but I'm not going to limit it to fart coin.
I'm going to leave it. I'm going to leave it with hot air rises. It's,
okay, there we go.
Until someone ignites. Until someone ignites it with a lighter.
There you go. All right, what are we watching for next week, buddy?
All right, number 3. Inflation. I mean, it was definitely a little bit of the scare this time around. We're going to get another, not next week, but the week after, we're going to get those inflation numbers. Do you think they're important this time around?
I don't know. It kind of feels like even if inflation ends up being higher, Trump is going to be saying, like, don't raise rates. So is the Fed's reaction function really, such that the inflation is going to change anything? I think that our number one thing. Well, anyways, I don't want to give away our number one. Let's go with number 2.
Number 2 is earnings.
Yeah.
And we at the time we're recording, by the way, we're recording this Thursday afternoon. So we, even though it's airing on Friday, we still don't know Apple's earnings, nor do we know the PCE price index and other little things that I think are worth noting. But we do also have a couple of key Mag 7s next week. And obviously, far enough forward will obviously be the critical Nvidia earnings, and we're going to look at that chart in just a second. But I still think that this is important to watch. While so far, when Tesla, Meta, and Microsoft came out, surprisingly, it was not a market mover at all. Like, really, it was a mixed bag, one up, one down, one flat. It was kind of it didn't create any gyration, but it doesn't mean the future ones can't. But up till now, it's been quiet.
Can I talk briefly about Tesla? Because I think it's kind of amazing. So one of the things that I like to watch very closely is the earnings revisions. And so this factor is one of the kind of best performing factors over the last little while. And what you see is if you get a situation where earnings come out and we get the revisions of the forward estimates for earnings, if they end up getting moved up, the stock goes up with it. And if they end up getting moved down, the stock goes down with it. And often it doesn't even matter what the analysts say, whether it's buy or sell or what they do. It's more important is what these earnings revisions do. I was shocked because Tesla, their earnings revisions hit new lows. Like they went down, the forward earnings, and the stock market's exploding higher. And did you hear the crap he said? He said
okay, stop it. They can't say exploding because nothing's exploding higher.
No, but I mean, it's just versus the fact that earnings are going down this much, I would say the outperformance is monstrous. And one of the things that I thought was amazing, Patrick, is that he said he expects something to the effect that he expects Tesla to be worth more than the top 5 companies combined. And it's just the stuff that's going on is just, this is wild. And it's wild how these were not good earnings. Like it is tough to put a positive light on this. And all I can say is that he just doubled down on like his hype, and yet he's a machine. He's a stock promoting machine. The guy is the greatest. He will go down as the absolute greatest stock promoter that has ever lived. No, he will
ever lived.
Honestly,
yeah.
There's no one even close.
I'm with you. And more importantly, the best professional gambler, because the risk he took on these elections, if it swung left, he would have been destroyed. And so he took a huge gamble on Trump.
Yeah,
and,
I guess that's true. I never
and now he's going to get the tailwind. But the thing is, as a short seller, who the hell wants to lean into fading this move when you know that the administration's got his back? Like, at this point, it's not like the SEC is going to go after him or some other type of a thing. Like, he's almost as bulletproof as Teflon Trump.
Yeah,
it's one of these scenarios where, and technically, when you look at this chart, this looks like a traditional consolidation to testing 50-day moving averages. Can you imagine this thing? Bull breaks out this nice crayon line. And double top retest to 500, or does this thing blast off to a $600-700 handle?
Oh, I like all this bullish talk out of you.
I'm just saying, it's hard to be shorted.
Yeah.
It's hard to be shorted. I'm not long it, but I'm certainly not going to lean into a short. Okay. It's one of those kind of like grab the popcorn and watch and see how this plays out.
What's our number one thing we're watching?
The number one thing to watch is the jobs numbers.
So I do think that is hugely important. That is going to be setting Fed policy much more so than inflation. And if we get, I don't even know, I don't have a view on them. I just think that unemployment, it means more than inflation right here.
Okay. Well, it's funny because inflation did move the market last time and jobs didn't. So it'll be interesting to see whether it flips. And this time around, it's the jobs numbers that might be more important. I'm not going to push back on it. It's going to be interesting. But you know what? I also thought that this pig in the python moment of Mag 7 earnings and FOMC was going to potentially and heighten volatility, and the market's really not moving. And so it's kind of like everything that everyone is staring at seems to often be baked into the cake. I don't know what kind of an outlier number would have to come in for the market to be shocked. It's just like what happened, which we'll talk about right now with the DeepSeek news that came out. It's sometimes the thing we're not talking about that we don't know we're supposed to be talking about that ultimately will be the straw that breaks the camel's back. But the likelihood of it now being these things that are so blatantly coming up and priced in, it's going to be hard for these to be the big market movers unless it's a big outlier number.
Yeah. So why don't we talk about DeepSeek?
Let's do it. Okay, let's start with I'll put up Nvidia on here, but clearly this was a big event in my opinion because the general got shot in the field. Like Nvidia, you're talking the generals, the Mag 7s are the generals, and there were arguably, I don't know if all 7 of them are generals, but I would say you could say there are 3 or 4 generals in that basket that of the Mag 7s that are truly the backbone of this rally. But if there was one that was the centerpiece of it all, was Nvidia.
Yeah.
And it was the very essence of the AI boom. And just like that, that's the saying, and Kev, I mean, me and you talked about it before. It's like I always have that saying that says, nobody cares till everybody cares, and then they all care at once.
Yeah.
And it's one of those things where it's like DeepSeek was talked about in advance, but no one cared. And then suddenly, I mean, I'm going to let you tell the story, but
because
go for it.
The reality is that paper came out on Monday, and I remember like we were passing it around, talking about it, and saying, is this a big deal? Blah 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 blah. It wasn't like this was new information that occurred on Thursday late afternoon when that finally kind of gathered some traction. And I initially had just kind of thought, okay, well, you know what? It's, some Chinese thing, and who knows if it's real. And I had dismissed it. And then all of a sudden over the weekend, it just got a life of its own. And it was one of those things, though, Patrick, where so many people were bearish. Like it felt contrived to me. And I know that sounds like I'm putting on a tinfoil hat, and if I keep talking like this, I'm going to get invited on the other podcasts that you go on all the time.
You will be.
But it really did feel to me that it was contrived by Andreessen and Chamath pushing this narrative. And even, Twitter, I think I wouldn't surprise me at all if Elon was putting his thumbs on the scale to tilt it to make this narrative gain traction. And it really felt like they were trying to torpedo Sam Altman and the big announcement of Stargate or whatever it was. And it just kind of, I think it got away from them. I think that they were too effective, and they got everyone so scared, Patrick. And I know you're going to say that was because the market was overly set up. It was too many longs.
Okay, don't say what I'm going to say. I want to say.
Okay, sorry. I'm sorry, but I wanted to kind of push back because I think that now we're right back. Like, yes, Nvidia got shot a little bit, but almost like the rest of the market's actually higher again. Like it wasn't, because there's no real damage.
Because it isn't, well, okay.
You think it's just AI
when you say real damage, it's first an Nvidia issue, right? First of all, I feel that you can't manipulate a stock easily unless the stock was fragile in the first place.
Yeah, I agree with you
stock
there.
that is being a stock that is being properly bulled. It's very hard to break it with a story without buy on dip traders immediately fading the news and taking it. So the stock already was on eggshells in some degree or another, and largely because of just incredibly rich valuations betting on the most bullish of scenarios, that they were going to be able to maintain this market share for a very long time into the future to justify their growth forecasts. And I think what really became evident was that the way everyone thought the future AI was going to play out was that there are alternative paths that it was going to take, and that there were different ways the AI story will play out. And all of those, I think they just have to take some of the air out of NVIDIA's valuation. And I think that a lot of the reason why the other Mag 7s are not reacting is what is NVIDIA's pain is in some degree or another their gain, because what NVIDIA having competition means that these other stocks that are the consumers of the NVIDIA chips have a much better access to developing AI at a cheaper cost.
Yeah.
And that is that could arguably be bullish for them. Point though is I don't think it was a market killer. It was an NVIDIA killer.
Okay,
news.
fair enough.
But with that said, when the general is shot, it is like taking one of the sails of the ship down that has been had the wind in it driving the market advance. And so if NVIDIA here, and look at it, 4 days after, it hasn't recovered. It hasn't recovered. And therefore,
that's a good point.
To me, that is telling me that the trend, like this could be whether you want to put a head and shoulders pattern or some other type of a rounding top formation, or like this is like if you go to a Nissan candlestick book and look at a definition of a rounding top, you can probably geometrically cookie cutter this shape on there. The point being that when you gap away out of a topping formation, that could be a shift of trend. And if NVIDIA is down, then and the question is that how much much further do a lot of the Mag 7s go? Like Amazon and Meta arguably have already finished key measured moves to the upside. Are we going to have a big breakout in Google and Apple to save the day? Like at some point, these are going to peter out. I feel that generally this, to me, hints that the stock market, while it may not be ready to go down here,
getting tired.
These are like
it's getting tired.
It's tired.
Yeah.
And so if the market's tired, then the question becomes, can it prairie dog? Like, will we see a scenario where these markets all break to higher highs, just sucker everyone in for the last thing, and then rug pull it after everyone gets, all the S&P at all-time new highs, porn hits its headlines, and then suddenly they pull the rug out from underneath it a week later.
Yeah,
I think there's a big prairie dog risk.
Patrick, we have some new viewers, and not everyone knows what a prairie dog is. You being the technician amongst us, why don't you kind of define a prairie dog?
It's in fairness, though, you're the one who introduced the prairie dog. As much as I'm a technician and happy to explain, you are the godfather of the prairie dog.
It's only because I'm from Winnipeg, and that was the most exciting thing at our zoo for many years.
I get the godfather of the turtlehead formation.
Okay, I will give you that gladly. So tell everyone what a prairie dog is.
Okay, so essentially what it is that when you have overhead resistance and a key level, then what happens is that the market breaks above it to signal all of the momentum chasers and technicians and everyone else that chases performance. When you have a technical breakout to all-time highs, everyone talks about it. Every technical indicator points bullish on the upside. Everyone gets the FOMO of, oh shit, the bus has left the station and I'm not on. And it creates one big impulse of everyone just wanting to get in. And the prairie dog is where that breakout is completely faded, trapping everyone that got either killed their shorts or rushed in, and the pattern reverses within days after the breakout. Would you like to add something to that?
The only thing I will add is the selling a prairie dog, like fading it, is the greatest feeling in the world if you get it. And I'll tell you, because
I've never tried.
Oh no!
Kudos to you, buddy. I've never tried.
The reality is, I'll tell you, I was the index derivative trader at the bank in Canadian Bank in the 90s, and I remember days that we would get up and something big would break, and everyone would be coming for it. And because we're the ones providing the liquidity, meaning we're doing the arbitrage, like we're selling the futures and then we're buying the stocks, inevitably we would probably be short, and sometimes we would just be like selling it and waiting to buy it back. And sometimes if we were really kind of bearish, we would just like sell it and just stand in there and just sell it to everyone. And then the thing would collapse. And my trouble is, Patrick, I have a couple of days that I remember doing this and we made tons of money, but even more so than the money, it was just that the feeling of being right.
The glory.
When everyone else was reaching for it.
It's like a hole in one.
Yeah.
It's like a
exactly.
hole
and then
in
you
one.
spend your whole life trying to get that hole in one again. And I do know.
And you lose it all every time. You know what? See, this is why I'm so bearish all the time, because three of my most profitable trades I've ever done was catching market shorts perfectly. I got the COVID crash, I got the Volmageddon, I got a few of these where I was making 500, 600, 700% returns on the option positions. That was the most glorious fucking thing that has ever happened to me. And now you get all these like burn marks on your hands from touching the stove and burning your hands trying to thing, because you keep etched in your brain the glory of those moments.
You still have fingers. I don't have any fingers left because I've been so busy trying to catch knives.
Oh my God.
Okay. So what do we got? What else you got? What do you want to talk about?
All right, so let's talk some charts and see what's going on. Now, for all of that talk that I said about the S&P, I will always like to step back and just reflect on where the market is. Now, yes, it could be a double top as it retests the previous highs. Yes, it could become a place where the market gets heavy. But just looking at it purely from a trend following perspective, the pattern of higher highs and higher lows, each dip being bought, general accumulation, above all moving averages, fib zones holding. So far, the S&P continues to demonstrate all the characteristics that the bulls are still in control. I often like to describe it to my members like using an American football analogy, who's in possession of the ball. And the Bulls are in possession of the ball. There hasn't been a turnover, nor are the Bears in possession making the drive the other way. And so at this moment, for all the shit we say, we have to respect that at this moment, the ball is in the possession of the Bulls, and it's their drive to make. Now, whether a Prairie Dogs or whether there's a turnover, we'll see whether some economic news turns the market. But the prevailing trend is distinctly bullish. What is interesting, though, is that when you look at the equal weight S&P and at the same time the small caps, they have only mustered up Fibonacci retraces to the upside. They were the centerpiece of the December bloodbath that was hidden under the hood of a Mag 7 disguised S&P market that was stable and Mag 7s that were running. But underneath the hood, we had market breadth go under 20% of stocks trending. The 80% were in a downtrend. It was insane to see that kind of dispersion of returns in that window. And we haven't yet really legitimately seen, even though the breadth has once again normalized back to like the 50% levels, we haven't seen these markets join the party yet. Or the S&P equal weight, where the rest of the market really kind of did anything more than bounce from an incredibly oversold condition. And so really, in my mind, if the Mag 7s can't blast off like Apple ripping and a few of these others making new big moves, then the only trade-off is then that you need to have massive sector rotation where breadth massively widens because they're such huge behemoths, where the whole broad market makes another big advance in the market, which could happen, but it's a pretty bold call to make that will be the case. And so to me, I feel like this still really needs the Mag 7s for the market to make another major bull advance at this point. And if they don't, then I think the market will be very tired and heavy. Doesn't mean that the immediate catalyst for selling will come, but I just think that there's going to be a lot of fake outs to the upside and a lot of just churning in trade ranges.
Well, I won't disagree that the Mag 7 sure would make it a lot easier, but would you not agree that a lot of others, like countries and other sectors, are feeling better than they have in the past? Like I saw a chart the other day. I think it was from Goldman Sachs that European European banks have beat Mag 7 over the last 2 years or something. Like this is the country that when you say you should buy European banks, like think about it. Everyone hated Europe and they hated banks even more. Like you used to say, European banks and they spit on the floor and tell you what an idiot you are. Like I
remember that day. Yeah. Like I was in that camp, buddy.
And like, look at these things.
But yeah, Europe, fresh, like a break that this is no prairie dog. Like this thing broke that 1 year, churn. And by the way, this is as an example of what the S&P can do for the basic next 3 months, where it rallies to the highs, comes back to the lows, comes back to the highs, and just ends up churning. In this case, Europe took a little bit of a spill in the summer, but that was all the markets did at that time. But the point is that this could be what the S&P does here throughout the first quarter of the year.
Yeah. And so, Patrick, by the way, I know we're taping this on Thursday. I see that there's some headlines going through right now that Trump has just said 25% tariffs on Canada and Mexico.
Oh, there
Listen,
you
go. I think that you're the problem here, Patrick. Because aren't you in Canada and then right now you're in Mexico? I think Trump doesn't like you.
No.
No.
No, he doesn't.
It's like
I'll have to live with it. I'm gonna find a way to persevere. Luckily, I'm all in U.S. dollars, right?
okay. All right. What else you got? What are the charts?
Actually, let's take a moment to just see what look at that. Look at the Canadian? What happened to the Canadian dollar? U.S. CAD. Look at that rip.
Yeah,
that's the news.
I wish I knew somebody
so
that was
just as we're
bearish
speaking,
Canadian dollars.
Yeah, I have no idea.
I don't know.
No idea. Do you know anyone that's bearish Canada?
Everyone I know is saying Canada is going to be great and that you should buy it because Pierre Poilievre is coming in power.
Yeah, unfortunately, that's a lag time of an extra year.
That's right. To be fair, he did change his opinion. It was originally, it was going to 6 or 7 immediate pop on the Trudeau announcement, and then it later changed to now I expect that over the next year.
Okay. There you go.
Anyways, what else you got?
There you go. Anyway, but listen, this breakout on the U.S. CAD could rip to 150. This is
Don't you be getting too bearish on me, buddy. Watch it. Prairie dog.
I'm all I'm doing is just talking the measured move. It could be a prairie dog, but I doubt it. Unless, of course, he flip flops on the tariffs because Canada folds on something. I mean, we could have a Colombia scenario where suddenly, the tariff is dropped 2 weeks from now because some sort of a side deal is struck, right? I mean, something that could happen, but purely alone. This thing puts another 300-400 pips at risk, 100%. And the euro at this stage, fading off the high. Even the pound sterling, perfect test that 50-day moving average into a fib retracement. Look, you know what? I know a few people that happen to be bearish the dollar. I don't know if you know anyone, Kev.
Those guys are pretty dumb.
Bearish the dollar. Yeah,
anyone
they're pretty dumb.
Bearish the dollar is pretty dumb.
But it's
By
okay.
The way,
come join the dark side here, Kev. Come join the dark side.
Come join the dark side. 1 second. Let me just tell you something because the currency whisperer gave me an update and I asked if I was allowed to say something about it. Okay, so here's what he says. For your information, I have maintained my long yen exposure since our last correspondence and added to it on Monday. Additionally, I bought some euro calls as well. While I think the path will be bumpy in the near term, it seems to, at least to me, that extended period of U.S. dollar weakness is upon us. While I don't generally like to be contrarian, this guy's a trend follower / FX guy. It gives me great comfort that this is not a consensus opinion and positions and opinions remain very constructive on the U.S. dollar. Lastly, given the tape bomb risks in the market, I don't expect a bullish U.S. dollar one. Anyways, there you go.
Okay.
I always knew I love that. I love the currency whisperer. Super nice guy. One of the nicest guys you'll meet, by the way. Absolute just saint of the world.
Awesome. Listen,
but
saint of the world or not,
he's wrong on the dollar.
No. But listen, in fairness, I want to just highlight a couple of things. Number one, this has not been any extraordinary U.S. dollar rally. This is a weekly chart, and this is just showing the rally that we've had in the last 4 months, right? Look at previous U.S. dollar rallies, and when you put them in context, any one of these, all of them, dwarf this tiny little rally that we have had in the dollar on a comparison basis. Now, we were in a 2-year consolidation of the dollar through 2023 into 2024. A major breakout like this could set in motion still a trend continuation that could easily send us still to 115. All I'm saying, I'm a trader. And when the U.S. dollar turns bearish, I'm going to take the Stanley Druckenmiller approach that I'd rather go all in on that kind of a currency move in the second inning of the game and know that a new U.S. dollar bear has begun, than to leg in carefully, trying to be a rock star, catching falling knives, which is essentially what you guys are doing. You guys are going to cut off your fingers all over again.
I don't have any fingers left, Patrick. Look, I'm on my toes already.
No, look, I'm not going to sit here and give you a milkshake theory on why the U.S. dollar has only one way to go and it's impossible for it to go down. U.S. dollar has gone through massive downtrends in the past, and it will do one again. And at some point, you guys are going to make a pile of money on your U.S. dollar short. I Just think it's way too freaking early. And I would rather miss the first leg of the trade and know that the actual US dollar bear market has actually legitimately begun, and then get in late, than to try to be a rock star here and call this turn. This is a US dollar bull breakout, and I personally think you have to respect this trend.
It's so much nicer, Patrick, when you fade it and you get it right. It feels so much better. Come join us.
Yeah, no, I won't. You're on your own, kid. All right. Let's very quickly. I want to just super fast. The asset that shall not be named. It's like the S&P, the double top, but the dip was bought, heading to the highs. My call on Bitcoin is the same. It has become a securitized risk asset. And if it's risk on and markets are ripping, Bitcoin's going to rip to a new high. And if we see that the whole market gets kiboshed and we begin some sort of big, deep correction, then I think Bitcoin will correlate. And so my call is not about going higher or lower. It's about the fact that I believe it will continue to correlate with at-risk assets. And it will follow that path. You going to push back on that, or can we?
No, I have no idea. I don't care anymore. I just like
Okay, you don't care.
I have no view.
Okay, let's talk about gold. Now specifically here. Still, I'm on the Feb contract. Let me actually show the April, because, by the way, the continuous contract roll today. So the continuous is showing $75, but that's the roll from Feb 8 to April contract, and the $20 contango is making it look like gold is higher than it really is. But let me just actually put up that gold contract here. Let's go to the April, and you can see here it virtually is about to break on the April contract to a fresh all-time new high. It has on the cash index and a few others, but it looks like gold wants to go here. And so it'll be very, very interesting to see whether or not this breakout is for real. What is particularly noteworthy about the gold breakout is the fact that finally some of the precious metals join the party. Ooh. So obviously silver wasn't budging at all, and suddenly you got a breakout candle. Look at me throw this crayon line, nice thick red crayon line here. Look at this breakout candle today. For the first one that is giving a potential starting gun for silver, starting a new move. Then you take a look at platinum attempting to get off of the mat. Palladium trying to turn back up. They're starting to try to close above their 50 days, trying to not make lower lows in these sequences. If these precious metals all join the party, then this is going. And then you take a look at the actual gold miners, like the GDX. Finally, an update that actually makes people feel like the miners are actually participating. And so for the first time, we got not just gold rising, but now that seems to have widened to broader precious metals basket. And it'll be very interesting to see if that finally signals that move. And if that's the case, the technical measured move for gold is all the way to 3,000.
I love it. I'm not going to say anything. No gootring.
No gootring.
No gootring.
Just don't tell me you're long as much as me, because we're going to ruin it.
No gootring. No talking about it. Next topic.
No, we're not going to say anything else. All right, next topic. All right. The copper continues to be in a mishmash. You can do the same kind of trend line like on silver, where you connect all these highs. What's interesting is it found support along its lows. It's holding this little flagging retracement down to its 50-day. Can copper join the party? What's interesting, the industrial metals have been awful. Whether you're talking coal, iron ore, or copper, they have not participated whatsoever. This has just not been where any flows have been. And so if copper starts to turn up, maybe, just maybe, it might bring some interest back into these incredibly beaten up space. Do you have on any of those three any comments?
Sounds good, buddy.
Okay.
You're on a roll.
All right, next thing, nat gas. Is this the buy on dip that we were looking for? I think you have to try. At this moment, like when you really step back, this is, by the way, I keep using the UNL, which is the 12-month strip ETF, rather than us looking purely at the front month.
No, this is a better way to do it. I agree with you.
Yeah, like because that way again the whole strip. And when you look at it on a weekly chart, like this thing, Eiffel Tower. By the way, that's another big technical pattern that we always talk about. But there were like this is as classic of an Eiffel Tower formation as you can possibly get. And we went through, and this thing fell off the other side of the Eiffel Tower and splatted on the concrete down below, and now it's actually coming to life again. And the question is, was this a turn? If it is, we should not see it retest previous lows. It should be bought on dip on a pullback like this, and we should see sustained price action showing a new wave of accumulation. These types of dips are the tell. To me, whenever you have a proper solid 50% retracement like this, if it's a bull market, the buy on dip traders show up at this level. And this is the big, huge tell. We're going to find out whether this is where shit happens or not.
Sounds good, man. You're on fire.
Rightfully so.
You are on fire, man.
The other one, the other one that's in the same situation is crude. Crude is literally pulled back right to the retracements, right to the 50-day, broken the same descending kind of trend line in terms of all of these highs. Will this be where crude oil musters up a support line test and becomes bullish? Point is, we're at these technical inflection points on all of these where they could pivot from being dead for the last year to suddenly them all taking flows. And so look, natural gas, oil, gold, all of these things are working. But you know what? All those basic materials, copper, iron ore, coal, none of them are working. And so you have to be a commodity picker at this point because it's not like a broad commodity rally. You have to be selective as to where things are happening. Comment before I go on?
No comment. I just, like, as I said, you're on fire.
All right. Let me just keep going then, because next we got to talk grains. And wheat finally is attempting to get a pulse. Obviously, soy has been behaving for the last month, and corn's been on fire. But wheat has kind of been stuck down along the low, and finally, wheat is showing a pulse. And that would actually put all three in line, which is something we haven't seen in a long time when the grains are all kind of all jiving together and moving in trend. If that materializes, we're finally seeing some of these agricultural names start to actually behave. You take a look like Nutrien and other names like this. After Nutrien's been in a 3-year shit show decline where the thing, lost 60+% of its value. Now, for the first time, we've seen a reverse off the lows after what's this pattern that I call here, Kev?
When turtle head
it breaks down below. Turtle head formation. This is literally for me the exact same glory as you catching a prairie dog. When you buy a turtle head formation and you snag it, I'm
sorry. I just can't take you seriously as you started telling me that you. Like, I'm sitting here listening to you. Oh God! Like
I'm trying. I hope you're being entertained. All right. So anyway, I like to look at it this way. There's this nice consolidation range right in here on Nutrien. And you can see after like this 4-month consolidation, this breakout on the upside and holding it. This is the first time Nutrien has done something bullish in a half a year. And will the bull market begin in these ag stocks? Is, I think, something worth watching for our listeners.
Wow, man. This has been one of the best talking charts I've heard. And honestly, I'm not just saying that. You had a lot of great charts there, like with a lot of technical areas that were very clear to me. Like even me, the bozo who doesn't understand all these squiggles, I looked at those. I go, oh, that makes sense. Oh, yeah, that's a good spot. Oh, yeah.
All right. So let me ruin it then by talking bonds.
Okay, go.
Let's just as you were talking about this being an amazing talking charts, we're going to roll up the sleeves.
I can ruin that. I can talk about bonds. Okay, go ahead.
It was an incredibly oversold market that got a bounce, but the bounce has very similar to what happened in November, simply met the criteria of an oversold bounce. At this stage, it hasn't beat its 50-day. It hasn't beat a basic Fibonacci zone. It is still too early to be calling a bull phase. But when you have a scenario like a test of this zone, if it, let's say, doesn't make lower lows on pullbacks and creates bottoming formations, that could be a key support line that establishes the lower boundary of bonds, which would put in what is the upper boundary of yields. Obviously, I'm going to use the 10-year yield, but I feel at this stage, it's a very, very reasonable chance that the 4.75 to 5% range on the yield is going to be a very heavy resistance. And even if retested, that's going to be the top end of yields until the next major inflation cycle, which I think is still years away from the next major inflation surge. And so I think that you can buy bonds on dips based upon these support lines. It's just, I think that you have to be patient because the entire first quarter of the year can be just a meat grinder. There's no reason to start aggressively buying bonds like this is going to start ripping on the upside in a big way now on the short term. It probably may even be a second half of the year story.
You know, one of the things that I will actually agree with you for the first time in a long time, when the curve was steeply inverted, so we had a situation where Fed funds was 5.5 or whatever it was, and the 10-year was 4.25, and you were sitting there, and it was when you owned the long end, you needed to be so right with your timing in terms of something bad had to happen in the economy for you to start winning on that position. It's now no longer so bad, meaning like, you know, the curve, basically it's actually positive on 210s, I believe. So for the first time, it's no longer costing you to be long bonds like before. And I kind of almost like Patrick, I find myself in this awkward situation where, you know, I'm no longer as bearish as I once was because some of your arguments are actually making sense about the economy. And I'm actually increasingly in
hold on. Danny, I'm going to need you to cut that little excerpt. We're going to put this on to X. This is going to be an important little thing that just timestamp it. It's the 48-minute of the talking charts. This is important.
There we go.
Go on. So, Kev, you were finishing.
So anyways, I'm with you. I actually think that especially given the extended exuberance in the market, even though when you look at, like, I'll tell you what I'm having trouble with, Patrick. Although it doesn't seem like there's a lot of longs in the market anymore. Like it used to be, you'd get on Twitter and everyone would tell you they're long bonds and everyone would explain to you why the world was going to end. And the St. Bart's crew were betting on sub 1% kind of Fed funds. Those guys are all gone. That's all gone. And in fact, there's actually people arguing the other way now, arguing about term premium and all this, yada, yada, yada. So that crew has changed. But one of the things that worries me, and this is what's holding me back from actually completely embracing your long position, is the fact that when you look at the JP Morgan institutional survey, the net duration of these institutional clients has never been higher. And so I'm having trouble reconciling this. It could be just a function that because rates are higher, they end up being longer, or maybe it has to do with their pension funds, and that the reality is that they're able to put more into the bond market. I'm not really sure, but that's the part that really scares me. It still feels like there's a lot of longs in the institutional side of the equation, and I'd feel a lot better if I knew that they still needed to buy, and it doesn't look that way. So I'm having trouble. That's what's holding me back.
You know what? Know what changes that very quickly? FOMO.
What?
And in terms of the trend,
but they're already long, so they don't have to they don't have to chase it. So yeah,
yeah,
the FinTwit
true,
community
true.
will change
But,
it. But
I'm
the real,
just saying, like the flows change with the trend, right? CTAs, all of the all the technicians.
That's true.
Flows,
in terms
all
of
these
trading
different
the
things,
squig.
kind of.
Yeah. Okay. Well, anyways, is that it?
That's all I've got. That's all I've got.
Okay, buddy.
You know what? I think that's enough, to be honest.
All right.
I think our listeners have enough to go with.
For sure. That was a great tracking charts. Thank you very much, Patrick. And thank you for tuning in. Listen, if you want to know more about Patrick's great big picture trading, where can they go find you, Patrick?
BigPictureTrading.com.
Go tune in. You get this every single day. You get to hear Patrick.
And you can follow me on X at Patrick Ceresna.
Oh, and
Kevin,
the YouTube channel. You
always
gotta
have
push the YouTube channel, buddy.
Yeah, no, listen, you go to the Patrick_Ceresna YouTube channel. Been firing off all sorts of videos that are fun. I'd love to get my subscriber base on that up. So if you're watching this, check out the Patrick_Ceresna YouTube channel and watch some of the stuff. The big one there is the Nancy Pelosi option strategy.
There you go.
Just explaining how she uses these
that was a heck of a
very
get
deep
for
in the
you
money
getting
options.
her as a guest. That was a huge get.
I did not get her as a guest. Unfortunately, I have this AI stuff that can give me a talking mouth. No.
Yeah. Anyways, you can check me out at
themacrotourist.com. Where can they follow you? Yeah.
Oh, they can check me out at themacrotourist.com. And listen, bull market, bear market, I was just glad to have you guys on for the ride. And thank you for tuning in. We'll see you next week. Now stick around for the after show.
Cheers, everyone.
All right.
Danny,
rate your beer.
help us out, buddy. Oh, what is there? It's a Modelo. Like this is like rating a Corona. It's a perfect summer drinking beer. I'm gonna give it straight down the middle, 7.5. That's what I give every beer that's a clean drinker. There's nothing special about it that makes it great. And I didn't even put the lime. It's 7.5 without the lime. With the lime, I think it's a 7.7. Ken. Okay, what's your question?
My question is, on a scale of 1 to skunky, how skunky is it?
1 to skunky? Like 1 being not skunky and 10 being skunky?
Yeah, Corona is quite skunky, so I'm interested.
You're a real snob. You really are, Daniel. You are a real
what's funny,
beer snob.
but you know what's
you classist.
You know what's funny though?
Like
it's but you know what though? Thing is that skunk in a beer actually, if I find, is depending on how fresh the beer is versus how long it's been on the shelf. And things like, for instance, Heineken. If you don't drink Heineken fresh, then it is the skunk of all skunk beers.
But you know what I think? If
right?
you have if a skunky beer is cold enough, it's drinkable.
Of course, you'd still drink it.
No,
you're
like,
gonna not drink it, but you're gonna be thinking about why the hell did I order this?
No,
skunk?
but like honestly,
like,
if it's cold enough, you can drink it. That's how I view the skunky beers.
No, you're gonna. I don't return a skunky beer. I'll drink it. I'm just thinking. Why did I order this beer? Right? Like but anyway, this particular can, I'm sure there are skunky ones. This one, I never thought about skunk when I was drinking it. So the fact that I had to think about it means that it wasn't skunky. I would have thought, because once I sense skunk, it's like the first thing you think of when you take a sip, right?
Yeah.
This is solid.
Okay.
It's a solid. You know what? It's a summer beer, right? Happen to be sunning in Mexico right now, and it's a perfect summer beer.
Now, isn't that the most classist thing? I happen to be sunning in Mexico right now. Mexico.
Right.
Then I will be sunning in Portugal later. Where do you summer? I summer in the Riviera. Where you? What's your ski chalet? Where do you ski, Patrick? Val d'Isere or Aspen?
The Alps.
Yeah.
In Vienna. Vienna in Austria.
Which one is it? Val d'Isere, where all the Russians go? If I got that right, there's
Listen,
one.
The Russians are everywhere.
There's
buddy.
one. There's one fancy place that's super fancy European ski hill.
Well, I'm not Russian, so I clearly wasn't there.
Hill Russians. And there's one they own, like all the oligarchs. Here it is. Let's see. It is blah, 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 blah. Oh, now they're not letting me. Business Insider's mad at me. They're not letting me do this. Courvichel, is that it? Maybe it's Courvichel. Yeah, I think it's that one. I don't know. Maybe it's St. Moritz. Anyways, they're places I've never been. Although, you know what?
You're the one that knows your sushi.
I think it's Verbier is the one that they go to. Yeah. Yeah, it's Verbier.
Okay.
Have you ever gone there, Daniel?
No.
No?
I don't even know where it is.
Seriously?
No.
Dude,
No.
I would much rather be surfing than skiing. And when I ski, I just go to like the shittiest hill I can find.
You just go to the bar.
That's close by.
Say.
Yeah.
Yeah.
and then I sit at the bar because it's too cold out on the snow.
Completely women. Okay, well, listen, it's after 4 and we got all sorts of earnings. So let's call it a day, boys. Thank you very much for tuning in, and we'll see you next couple of weeks. Take care.